Welcome in PharmD Nation. One of the biggest heated debates that happens in the financial services industry is which strategy is better, active investment management or passive investment management? And the reality is that decision is made not by which is better, but by what the investor is actually trying to accomplish. So in this video, we're going to break down some of the differences between the two so you have some solid pieces of information to use as you compare which is better for what you're trying to pursue. So active investment management is how it sounds. It's actively buying and selling in a portfolio by an investment manager to beat regular market returns. Where passive investment management is, there's not a lot of buying and selling, there's not a lot of activity going on in the account. You invest your money in the market like a S&P 500 index, and you take what the market gives you, no more or no less. Active investment management is going to be higher cost typically than passive investment management because you have to compensate the activity by the portfolio manager that he is doing in order to try to produce a higher rate of return than what the market is going to produce. So you have to compensate him for that, him or her for that. So it's going to be higher cost for you as an investor to take advantage of active investment management. Passive investment management has low flexibility, so you're not going to have a lot of ability to be able to customize an investment portfolio exactly the way you want it, where active investment management will allow you to have that flexibility. Passive investment management is tax efficient because there's not a lot of buying and selling going on. You're probably not going to incur a whole lot of capital gains tax, where active investment management, you may. Active investment management, you could be much better at tax management than passive investment management. So you can take advantage of things like actively selling losing investments to take advantage of tax loss harvesting, for example, where passive investment management, you're really not going to pursue that type of thing as often. And finally, active investment management is more short-term viewed in nature, where you're trying to produce a greater rate of return in any given year than what the market can produce. Passive investment management is more set it and forget it, where your view is more long-term because you think over the long term you can't beat the market, so you might as well just take what they're going to give you over a long period of time. So when you're trying to determine which situation is best for you or which strategy is best for you, start by trying to identify what you're hoping to accomplish and use some of the stuff we talked about in this video to help you determine which strategy is best for your specific situation.